Hello, Startup Vision. My name is Oliver Gottschalg. I'm Associate Professor of Strategy at HEC Paris, and I'm very happy to discuss a variety of questions related to venture capital and startups in the current world after COVID-19.
Hello, Oliver. Thank you so much for being with us here on Startup Vision TV and sharing your thoughts once again about what's happening in the world of VCs and investments and startups. You are a specialist, as we know, on private equity with a special focus on the relationship between the LPs and the fund managers. So first questions, of course, we want to understand more. What is the structure of the LPs, of the money given to the VCs in general? Can you explain?
Certainly. I mean, as an entrepreneur, you're looking at this whole universe of venture capitalists and you're scouting out which is the right VC for you, which is the right pocket of capital. But it's important to broaden this out a little bit and understand the entire food chain, so to say, of the capital flows into the startup companies. And that food chain chart starts actually with the limited partners, with institutional investors very often, pension funds, sovereign wealth funds, bank affiliates, family offices, endowments, who select to put money into venture capital funds in search of attractive risk-adjusted returns in general. This can sometimes include also individual investor, but for the most part, this is institutional capital that's behind the venture capital fund. This implies that the VCs themselves have to be very careful in screening for investment opportunities because they have basically two sets of clients. They're sitting between the sources of capital and the investee companies, and so they have to scout very carefully what are the type of projects, the type of entrepreneurs they want to bet on in order to generate at the portfolio level those risk-adjusted returns that ultimately attract capital into their funds.
And you know, something we would like to understand, because really the world completely changed. Do you think that the risk factor changed since last February?
Clearly, yes. I mean, COVID-19 has changed all kinds of the economy, all kinds of the capital markets. But one could actually say that the venture capital has relatively little effect from this. Let me explain. You look at the world out there currently, and all kinds of asset classes, all kinds of investments seem much more risky in the eye of the capital owner, capital allocator than they looked like 2 or 3 years ago. It's true for the stock market, it's true for bonds. Government bonds seem to be more risky. Venture capital has always been risky. It's always been an asset class for those who says, well, we can handle risk, we can assess risk, we can put it into our decision-making and then scout for those opportunities which are still worth pursuing given the inherent risks. Now, did the crisis make also startup business plans more difficult to implement? Did it make venture capital activity more risky? Probably so for many startups, but we're dealing with an asset class who's kind of equipped to take care of it. So from a relative scale, I think the impact of the crisis has been much greater on the type of investment that were considered reasonably secure, and now we discovered they're actually quite risky as well, than for an asset class that always had a high level of risk, which now may have increased at the margin a little more.
And do you think, this is a very important question, you know, that every startup is wondering about, do you think the money will continue to flow from the LPs to the VCs and then to the VCs to the startups to make this ecosystem work?
Likely so. Of course, always with some qualifications, but you have to see the money is flowing in stages. Limited partner commit to a private equity fund by saying, hey, I'm going to put 10 million of my capital into fund XYZ. That's a firm commitment at the beginning of that fund's life. Now, that fund now then has a 4, 5, 6 year investment period over which it can deploy this capital. The capital may still be sitting in the bank account of the limited partner, but the venture capitalist has a control, basically an option to call that money and put it into the right startup whenever the venture capitalist decides. So even if limited partners decided to cut off the VC world from new funding, there's lots of so-called dry powder still in private equity funds, venture capital funds that were raised over the last couple of years, and that still have some years of investment period ahead of them. But obviously, I wouldn't say or assume that capital flows from the LPs to the venture capitalists stop. Certainly, many limited partners are capital constrained right now. Some of them are slowing down investment activities, they're recalibrating how much money they put into different asset classes. But for the reasons I mentioned a few minutes ago, several of them will probably look at the world and say, hey, VCs are still attractive from a risk-adjusted return perspective. In particular, they may seem interesting because the world is full of uncertainty. The world is full of problems. There will be startup opportunities. There will be entrepreneurs who solve those problems and thereby build viable businesses. Venture capital has the power to finance those business plans and benefit from them financially. So the limited partners with a long-term investment focus and those who still have some resources to invest in, there's a lot of capital still in the system, they will likely continue to deploy so also in the VC space.
And you're absolutely right. You know, it's important for LPs also to continue investing, because in fact what you spoke about was you know, the extent, the period over which they invest. They want a return in 7 to 10 years. So if they don't invest now, they might have a crisis in the coming years. So they have to continue this flow of money, in fact.
Yeah, it's a long-term industry, and rightfully so. The strength of private equity in general, and including venture capital, is the relatively long-term nature and the ability to be counter-cyclical. In essence, this option that the venture capitalist holds to decide on when the money, the limited partners' money, will ultimately flow, that option is very valuable because it'll gently force the ultimate owner of the capital, the limited partners, to invest in times which are often really good opportunities, but because of a generally amplified view on riskiness and a general prudence and certain liquidity constraints, people structurally fail to act in those times, and the VC often are the ones on the trigger and kind of force then the limited partners to put money at work when it should be put to work.
And what would be your advice to entrepreneurs that are afraid, you know, not to find any money, to be short of cash? What would you say?
Well, everything one would say in general about, you know, making sure you work as hard as you can to not only get money, but also get the right venture capitalist still applies. I think the one area of additional advice that I would consider to give, in particular in certain parts of the world, would be to look very carefully at the ability as a startup to benefit from some of the government helps, government subsidies that are certainly currently put in place in response to the crisis. In normal times, it was very difficult for startups to get any type of debt financing in many parts of the world. Now, as has been told, some of the measures that government puts in place across Europe and certainly also elsewhere may be such that startups qualify because the hurdles are lower to obtain some kind of quasi-debt funding that often comes with very interesting terms with respect to debt repayment and interest payment. It may be worth the entrepreneur's time to explore those opportunities as a complement to direct venture capital investment.
And as I was mentioning, as an expert, we want to know if you're positive or negative. What do you think? What will be the future? How do you see the future?
Please allow me to focus this answer very much on the venture capital world, because otherwise it has too many aspects.
Of course.
I'm an optimistic person by my DNA, and I continue to be optimistic also for venture capital. Very much along the lines of what I mentioned before, the world is even fuller of unsolved problems these days, of unsolved problems that can be addressed with economic activity. I think the world is also full of bright entrepreneurs and entrepreneurial teams who know to solve those problems, to address them, and ultimately build the type of businesses that deliver the services we need in a way that allow for the buildup of enterprise value. So by no means do I think the crisis will be a dramatic long-term setback for venture capital as an activity. On the contrary, VCs and entrepreneurs should feel encouraged because they're the ones who now have the opportunity to actually bring the solutions to the world that we're all waiting for.
And do you think it will be like the end of easy money and maybe go back to fundamentals and, you know, I mean, and see, maybe we saw valuations that were kind of crazy and no returns or no earnings. Do you think that's the end of it?
This is always going in cycles. Yes, there have been excesses. Yes, people lose lots of capital, but you know, we could dig out dozens of articles of why people thought that Amazon was dramatically overvalued 20 years ago. So were many other startups. And every hype, it's a typical curve. Things are exaggerated in one point of time in one direction. They will flatten out. I think this is just part of the normal cycles, and the current crisis is likely going to be no different in that respect. If we look back in 10 years, certainly some valuations from 2019 look ridiculously overpriced. Others may look like a really good bargain 10 years looking back.
Okay, thank you so much, Oliver, for sharing all those thoughts and what you know, your expertise with us on Startup Vision TV. Thank you so much.
My pleasure.